Hello and welcome to Money Matters TV. I'm Mike Dever, founder and CEO of Brandywine Asset Management. And my co-hosts today are Jeff Watkinson of Watkinson Capital Advisors, municipal bond specialist, and Eric Parnell, chartered financial analyst and chief market strategist from Great Valley Advisor Group. Hello, everyone.
Hello, Mike.
Hey, Mike, how you doing?
Hey, doing great. So today we're doing a round robin. We'll just pose questions and kind of respond to each other, and a lot of topics about uh, general market events and conditions today, and we'll sort of pick your guys' brains and see where that leads. So I do have a audience question before we get started, and this is from Mark Edwards of Philadelphia, and Mark is asking, how do you analyze stock and bond trends in today's market? And I'm thinking that might be a good one for you, Eric.
All right. Well, thanks, Mike. And Mark, that is a great question, because it's one of the challenges for investors when they're thinking about buying stocks or buying bonds. You can do the fundamental analysis. You can take a look at corporate earnings. You can take a look at financial health for stocks. You can take a look at interest rates for bonds, and you can gather all this information to decide what types of investments you want to participate in. But when you have all that information, it's like you can feel and smell and taste a good investment, but you can't see it. And that's the trends that you're talking about. So a good source to help identify trends in stocks and bonds in today's markets, you can go out into any search engine and type in technical analysis. And if you find information on technical analysis, that gives you the eyes and the vision in order to identify, okay, this is a healthy company and a good investment, but is the trend higher associated with the stock, or am I going to fall into a value trap? Or with bonds, it might seem like a good time to buy bonds, but what are the trends in underlying interest rates? So looking for sources, technical analysis, and you'll find a number of tools on the internet that are available for free that you can educate yourself on in order to best identify these types of trends.
Hey, thanks, Eric. I think that's great. A lot of people kind of neglect. I know for years, technical analysis was sort of downplayed, and it was just ignored to a large extent. But the reality is, even if a market or a stock is a good buy, it's got good fundamentals. If it's in a sustained downtrend, don't catch the knife. Wait till the sentiment changes, because in the shorter term, it's really sentiment that drives the market, and that's what shows up in the technical analysis. So I appreciate that response. And for any of you, if you'd like to send in your questions, here's how you can send your questions to Money Matters TV.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, MONEY, -matters, MATTERS, TV.com.
Okay, thank you. Welcome back. Okay, let's get into the round robin. I have a question out of the gate. All this talk of AI, it's affecting pretty much every industry now, certainly technology, and we're seeing it in investments. I actually saw some articles recently that were talking about how AI is better at stock selection than experts are at stock selection, which doesn't shock me. I in my book, I wrote a book about 13, 14 years ago now, and in that I had a chapter on experts and expert decision making. And it was really interesting because it had all these experts for college admissions and determining who should be accepted into the college. And they had all their different criteria they were using. And they were moderately accurate, but they ran it through then a systematic model that just looked at specific traits of the candidates, and it was by far superior to the individuals that were evaluating people based on all these other criteria, the essays they wrote, and different things like that. So it's really interesting that there are specific data points that can really help with investing and in general. So I have a question for you then, Jeff. I mean, how is that affecting Muniland? What's that doing in the Muni markets? Do you see any impact from AI?
Thanks, Mike. That's a great introduction, and I'm really piggybacking on our last round robin session in the spring, when Eric gave a tremendous explanation of AI. And I mean, I'm going to keep this not at a 30,000 foot view, but like a 90,000 foot view. And artificial intelligence is very efficient in analyzing data, implementing functions, but analyzing data. And the municipal bond market has oceans of data. We have more data than we know what to do with. And I've actually been speaking with a gentleman who's writing a series of articles at Forbes. I reached out to him on LinkedIn. Fascinating stuff. Barnett Sherman is the author. He's teaches a class at Boston University, and it's the amount of data, and he thinks it's going to impact credit analysis, underwriting, pricing, trading. And I'd like to give you an example of how it can help pricing, because the municipal bond market has been described as opaque, at times illiquid. Other financial advisors really do not like to trade municipal bonds. It's, this bond hasn't traded in 2 months. What is it worth? And I thought for today's discussion, I would bring in a slide which shows a comparison of some characteristics of the municipal bond market. And this is the problem that many, including myself, think that AI is going to address. So, numbers by themselves stand in a vacuum, but this is a very simple side-by-side comparison with corporates. So I'm going to make a sentence here, and I'm going to do it bit by bit. So municipal bonds, $4.4 trillion. It's about 40% the size of corporates. Number of securities, 1 million. Let's round up the 47,000 to 50. So it's about 20 times the size. Whew. And average trading volume, 13 divided by 1,444 is less than 1%. So let's put that in a sentence. Here's a market that's the fourth the size of corporates, has 20 times the number of securities, and trades approximately less than 1% the amount of the corporate market. And
wow.
I saw a stat the other day. It said less than 2% of municipal bonds are actively traded. And what does that even mean? Did it trade today? Sometimes these bonds, did it trade every hour? Did it trade a certain amount? But what I do know is it means that 98% of these bonds do not actively trade. And I think that with AI delivering information, it's going to create a better idea of what that bond is worth. That's a big job of what our role is. But what is this bond worth? This A-rated sewer system in Ohio that hasn't traded in 2 months, with a 4.5% coupon and a 10-year call and a 20-year maturity. What is that bond worth? Is the bid I'm getting a good bid? That's just one specific example of, and companies are doing this right now. I haven't been able to speak with these companies yet, but I'm interested to see in their solution that they're bringing to the marketplace.
You could, first of all, could you bring that back up again, that chart? So one of the thing that caught me, you didn't mention here, default rate, is that right? 0.09% versus 2.2?
Yes, sir. That is less than 0.09 is less than what?
1/10 of 1%.
1/10 of 1%.
Yeah. Yeah, it's amazing.
That is
so it's trade on a savings account.
Right. Yeah.
That is the historical default rate for investment grade bonds between 1970 and 2022.
Mm-hmm. Okay.
That
Wow, that's
shows
great.
the resiliency of this asset class. And that's another point. I don't want to steal the author's thunder of he's going to do a whole section on the value of credit rating when default rates have historically been that low.
Right. Yeah, it's almost meaningless to look at a credit rating. It's if it's investment grade, it's just telling you it's safe. The other thing that was interesting what you're saying. So with only that 2% active trading, the today when you're trying to price, you must have some sort of models you're running to come up with a value that you think there should be,
Good question. I'm
right?
going to stop you right there. This is how inefficient it is. It's called matrix pricing. What's the eval on that bond? Well, that gives you a number. It's based on bonds with similar structures, similar credit ratings that have traded recently, but it's based off a block of 1 million bonds.
Mm.
We're looking at a block of 25 bonds, 75 bonds, 125 bonds. It's a lot less liquid. There's a lot lower bid. So we always bid below that eval, and because there's less liquidity there. Our $9 trillion neighbor in Malvern, they don't care about 75 bonds or 125 bonds. They're buying $5-10 million, $5-10 million lots at a crack. That's going to be improved. That's a great question. That's a great example right there, Mike.
Okay.
Jeff, you mentioned, low default rates, market inefficiencies in terms of pricing. It seems like there's a lot to like here in terms of municipal bonds from a market opportunity in general. I know in talking to advisors and clients, when they ask, they say, well, what area of the market are you most enthusiastic about right now? Thinking they might provide an answer like, the tech sector or something like that. And my response is there's a lot to like in the investment grade bond market right now. And in particular, there's a lot to like in the municipal bond market right now in terms of the value that at least we're seeing. Am I wrong in that thought, or how are you seeing the municipal bond market here today?
It's a great question, and we couldn't agree more. Even though interest rates have gone up dramatically over the last 2 years. 2 years ago, you had to go out 10 years on a AAA rated GO bond to get 1%. We've been extending maturities. We've been going out 15, 20, 25 years, bonds priced to a 10-year call. And we're looking at yield levels at or above 4%. And that's tax exempt. So, there's tremendous value there in the belly of the curve, not to get too technical, between like 8 and 15 years maturity. Actually, prices are higher and yields are lower. It's interesting. The yield curve it's inverted. And we've been finding value with our barbell approach, not only 8 years and in, but then we barbell going out further than 15 years, trying to lock in a 4% nominal tax exempt yield, which has a tax equivalent yield of, depending on which state you live in, over 7%, even pushing 8% in a high tax state. And 8%, that's very close to the historical return of equities. And that's really been an area of opportunity that we've been focused on.
Jeff, you mentioned states there, and that was another question I had for you because, you think of muni bond portfolios, you think of New York, you think of California. What are some other states, state-specific municipal bond categories that if, for investors to say, hey, I live in this state, I should be thinking about, a state-specific municipal bond portfolio, or are investors better to just stick with a national approach?
Great question. When you have the top marginal tax rate in California pushed over 13%, so it's New York, California, Oregon, Hawaii, New Jersey, Connecticut. We have a manual. There's 50 different states. There's 50 different markets. There are a handful of states such as Texas, Florida, Wyoming. I think maybe both of the Dakotas. I have a book. I don't need to memorize it, of states that have no state income tax.
Tennessee.
But I remember Phil Mickelson was complaining about this 4 or 5 years ago. He goes, I'm paying over half my income to federal, state, and local taxes. And that is the truth for a top earner in California.
But that was really his fault for playing so well, right?
Yeah, self-fulfilling prophecy.
He needs to lose more often.
That's a great question. And if Pennsylvania's got a flat tax of state income tax of 3.07. We have a North Carolina client that's 5.5%. Every state is different. Everything is at the margin, and it really behooves you to look at in-state bonds if you're a resident of those states I just mentioned.
Well, I appreciate that. That was, again, you're obviously very knowledgeable. And munis, it's not an area I've ever really covered myself, so I always appreciate having the opportunity to talk with you about it. Maybe let's go into more of a macro discussion. Where are we at with the economy, with markets? We got a political cycle here that's probably unprecedented in the history of the country. I'm thinking, Eric, this would be a good area for you to let us know what you're seeing there.
Yeah, no, well, it's an interesting time in the markets as we head into the summer because, as we were coming into 2024, one of the concerns was, is the economy going to slow? And if it does slow, what does that mean about the Federal Reserve and them? They're taking action to lower interest rates. You think back to the beginning of January, and there was the expectation that the Federal Reserve was going to cut interest rates by as many as 6 or 7 quarter point interest rate cuts through the course of 2024. And, here we are in the middle of the year and there hasn't been any so far. And that's for good reason, because the economy's been stronger than expected. The inflation readings, although inflation continues to trend, towards, a slower rate of inflation as we've gone through the year, it's not come down as much as maybe people have expected. So a stronger economy, a little bit stronger than expected inflation. Well, the Fed's not going to cut interest rates in that type of environment. But we're now here in the summer, and we've started to see some themes materialize here for the second half of the year. We've seen some readings here in the last couple of weeks that suggest that maybe the economy is starting to slow a little bit more materially. But if inflation pressures start to rise, because there's still a lot of inflation out there, if we see a renewed rise in inflation in the second half of the year, all of those investors that have kind of been banking on the fact that the Federal Reserve will cut interest rates if things start to get soft in the economy. Well, if inflation starts to rise anew, that will put a real block in the ability of the Federal Reserve to cut interest rates. So those are going to be 2 key themes to watch as we go through the second half of the year. Is how does this strong economic growth we've seen in 2024 continue to hold up through the remainder of the year? And if it does start to soften, where do we stand with inflation? Is the inflation rate continuing to trend lower, or are we starting to see some upward inflation pressures that we need to worry about? So that's going to be a key theme in the coming months.
Okay, how do you explain, because part of it is also consumer expectations for both for inflation and for the economy and the environment and for employment. How do you explain that? I feel there's a bit of a dichotomy here. You've got strong economic growth, really great employment, high employment, low unemployment. Inflation's been sticky, but obviously came way down from that upper high single digit numbers we had there when the Ukraine war really kicked off. But you still have people feeling and talking very negatively. They don't feel positive about the environment, the economy. How do you explain that?
No, it's a great question. And one of the things that I always like to think of is, what resides underneath the hood? You think about the S&P 500, and it's had a fantastic year here so far in 2024. But if you take out a handful of stocks like NVIDIA and a couple of other names like Eli Lilly that have done phenomenally well, these big mega cap names, the returns in the market aren't really as exciting as the headline might suggest. Same thing's true with the inflation rate. we see the headline inflation rate coming down. We even see the core inflation rate coming down. But if we get further underneath the surface, we have two different types of goods that people, or two different types of items that people purchase in their CPI basket. There's goods and there's services. We've seen goods inflation really come down in a sustained rate. But when you talk about services inflation, things like hospital services and things like rental cars and entertainment and things like that, we're actually seeing a renewed rise in inflationary pressures in that area of the economy, dating all the way back to last September. I mean, the inflation rate was coming down on services ex shelter. Outside of rental costs, that inflation rate had been coming down from September of 2022 all the way through September of 2023, got all the way down to 2.8%. But since that time, it has started to rise again. And now we have services inflation ex shelter approaching 5%. I mean, that's pretty hot inflation in any type of market environment.
Yeah, 5%. I can see that, and also you say X housing. Housing's still an issue, I believe, too, right? With rental, I mean, they've come off, they've softened some, but there's still pretty strong rental market out there.
Yeah, that's the thing. There was such an expectation coming into 2024 to say, you've got all these apartment units and all these rental units. At some point, that's got to top out, and we see that the price increase in those rental units come down. Although there's indicators that suggest that those rental costs will come down as we go through the second half of 2024, I mean, they've still been pretty sticky in that 5%, 6% annual increase rate, which is, that's pretty hot. And one of the things that'll be worth watching in the second half of the year, and that's one of the reasons I say ex shelter, is that even if we do see those rental costs start to flatten out, we want to keep an eye on those things because it makes up such a big part of the services component. We want to keep an eye on those other things within services if they still are rising at a high rate, because those are the things that cause consumers to feel pain in terms of how they feel about the economy and their current status in that economy.
Eric,
right now,
I got a question for you.
Sure.
I want to jump in here. I mean, I'm mostly focused on munis, but I mean, I remember reading in the journal several years ago, like this was the most hated equity, bull market of all time. And now we have NVIDIA every week hitting new highs. I think it's the old story of fear versus greed. And, when was the last time the Fed was able to navigate a soft landing without driving us into a recession to control inflation? But then there is inflation, and then there's the fear of missing out on the gains we've seen in tech, specifically, I guess, AI. I mean, how do you balance those expectations? And here we are mid-year 2024. I mean, it's something I think about a lot. I'm curious what your thoughts were.
No, absolutely. Because, one of the things we're seeing with NVIDIA right now in this, this semiconductor stock, it's the gateway to artificial intelligence here in 2024. It reminds me a lot of Cisco systems back in 2000, which was the gateway to the internet.
I almost said the same thing, Eric. It's so similar. People are looking at it and saying, well, there's so much demand, and back then with building out the internet and distribution and fiber and cable and Cisco, I mean, as I remember looking at it a year or so ago, it was still trying to come back to the highs it had 20 years prior. So I'm not saying that's going to happen. I'm just saying that there's a lot of similarities, and at some point, one company doesn't dominate, make all of the margin in the industry. There's other companies that realize there's an opportunity. Intel's already starting to catch up in some areas, and those margins start coming down, and the distribution of sales and orders gets spread out a little more than the one company, right? I mean, that's
that's absolutely it. Just like the internet transformed the economy and transformed the world. I mean, yes, we had a .com bubble and most of those stocks aren't around anymore. But the reason we had a bubble is because it was known that the internet was going to change the world. And Mike is such a great point, because it's not just Cisco. It was companies all across the sector spectrum that have benefited from the internet over the last 24 years. I think the same principles hold true with artificial intelligence today, is that it's not just one company that provides the chips that's going to benefit from artificial intelligence, which has been kind of coming along for years. I mean, the Chat GPT got everybody excited about it, but it's been coming along for years. And there are going to be companies all across the economic sectors that are going to benefit from the advent of artificial. And, getting back to Jeff's point and all the things that he was talking about earlier, we look at the municipal bond space. Wherever there is a company or a sector or an industry where there is just a wealth and preponderance of data that needs to be analyzed, those are the companies across all sectors that are going to benefit from this. And this is a phenomenon that will take place over the next 10 to 20 years. So it highlights the importance of diversification, because it's not just one name. It is a market of stocks with so many that can benefit from this.
Yeah, and I've been seeing people supporting NVIDIA's valuation by saying it's not a .com, it has earnings. They're actually growing, but that was the case in a lot of the infrastructure providers in the .com bubble, until the people that were buying it from them couldn't support it any longer. And so that's one of my concerns. Is you've got, I don't know, 50 billion in new chip orders that have come through, that in the last whatever short period of time, just some rough numbers I was looking at. And what's the profit going to be on those people purchasing those? They're not all going to be making money. Yeah. And so at some point, that gravy train sort of does dry up a little bit.
Exactly, because at what price for earnings, and in the case of NVIDIA, at what price for sales? It's a company that's trading at more than 40 times sales. So, the growth opportunity is undoubtedly huge in the artificial intelligence space. But the question that investors should always be thinking about in the back of their mind is, at what price do they want to pay for certain types of exposures in that area of the market?
Yeah, exactly.
It's fascinating. I mean, I remember in the spring, both my uncle, who was a chef, really doesn't know a stock from a bond, asked me about NVIDIA. And so did a friend of mine's mother at Home Depot. And I'm like, oh boy, we're at the top. And that was 30 or 40% ago.
Yeah, right.
I do think what we're seeing in AI, and we're seeing it in other areas too. We're seeing it in some of the cryptocurrencies. There's continues to be a lot of enthusiasm in the cryptocurrency space. We're seeing it with some meme stocks. I mean, 3 years on, and now all of a sudden we're talking about stocks like GameStop and AMC Entertainment again. When you see this type of enthusiasm and this type of fervor at any price for companies that could be evaluated in a variety of different ways, one of the things that highlights to me is that the liquidity environment, it's almost like an anecdotal example of how abundant the liquidity environment continues to be here in 2024. It's whether it's from government transfer payments or maybe, if Fed policy maybe isn't as restrictive as people think that it is, there clearly remains a lot of liquidity in the marketplace. And, that's a double-edged sword, because liquidity can support higher than expected valuations for an extended period. But if there's a turn in that liquidity environment and liquidity starts to dry up, then that's where you get your 2022 style market corrections.
Yeah, everybody can't escape at the same time. That's unfortunately the situation, and that's why markets, when they drop, they tend to drop far more precipitously than they have gone up. And thank you, Jeff and Eric. Really appreciate it. Again, we could go on. I've got my list of things here for another hour and a half at least, but we do need to end the show, and I appreciate it. It was a lot of fun again. Thank you. Our next guest on Money Matters TV is Maria Massaccini, CEO of Anovis Bio. We'd like to thank you for watching Money Matters TV, where your money matters. See you next time.